Let's get started. Good morning, everyone. It's nice to have you here along for our laboratory class. And I appreciate everybody showing up. And for those of you who are coming in as a recording, you're welcome too. Um, we're going to be looking at the funds today. We're just going to go through and look at the markets that I am going to, as I put out on the little marquee, out on the little thumbnail, what I'm going to be looking at picking up and buying. I want to show you something though. I've done a little bit of extra outside work and I want to share it with you. And so to get started right off the bat, I just kind of want to jump into my spreadsheet. All right. So this is my spreadsheet of my portfolio. This is just one portfolio. I have three, actually four UBI portfolios. This is just my biggest one. All right. So this is my largest one. I started with in this account this year $480,000. So that's what I started with. And here towards the end of the year, I still got a couple of dividends to come through in, of course, the month of December, and November is not done yet. We get one more dividend today. So I'm expecting that to be close to $6 to $8, maybe $10,000, which will bring that up to around 38,000. All right, so you can see that down here. Let me get myself out of the way here. How can I do that? Where do you need to go, land where you're not interrupting everything? How about there? All right, so you can see down here, my monthly average is 32,000 on this particular account. That's what I'm bringing in. And so my dividends so far this year have been $407,000 on a $480,000 investment. So in 1 year, I think that by the end of the year, I will have a cash cow. Maybe. No, I don't think I'll quite be there. So 407,000 is my total dividends. I put in 480,000. So I've made throughout the year almost, not quite, almost 100%. I don't think I'll quite get there. If this comes in to be around 30,000, this be at 30,000. See, that one was 64,000, but that was a reconciliation month. They did that when they were going, well, this was a big month too, 53, probably another reconciliation month. I'm not sure, but this is, I'm certain this was a reconciliation month because they went from monthly payouts to weekly payouts. And so that's why that was so big. So that was a reconciliation month, not usual. That's an unusual month. So, but you can see back here, January was 30,000. So 64,000, 29,000. I think that's kind of the range. Well, you can see an average of 32,000. So if this comes in around 30,000, this comes around 30,000. This is going to be a little more. I think it's almost at 30,000 now. So total dividends, I've made 407,000. Now I've lost some money on the NAV, right? Net asset value. So just on the NAV, you can see that I have, well, I made 87% on the NAV. That's not right. That says I got a 702% return, which, that's not correct. I got something wrong in my spreadsheet. I'm going to give you this spreadsheet with your Pit News Magazine subscription. I'll find out what's going on right there because that doesn't seem right. Current NAV value is worth 400,000 and the NAV difference 351. I put in 50. There's no way that current NAV value is 400,000. That's coming in from Microsoft right now. So that was NAV plus yield at 829 on Tesla. That's not right. Something screwed up on that one. So don't look at that one. That's going to screw up our numbers. That's frustrating. So I've got the NAV. All right, NAV plus the yield. So I broke this out. And what's really cool, and I want to show you something, is this is my NAV. I feel bad. That stupid Tesla's screwing things up for my presentation here. So I got capital in, I got capital out, and I've got total capital invested. And then I've got my NAV plus my yield. So remember, what we do is we do a yield plus investing. So we're more interested in the yield than we are the NAV. Doesn't mean we're not interested in the NAV. We certainly are. And we're going to be talking about that more than. What's John saying? Why are you mad, John? My microphone off again? Can you not hear me? Many yield max funds did reverse split. Yeah, that doesn't mean anything. They're just reevaluating stuff. It's not going to hurt you at all. Not going to make any difference. They did a bunch of, that's probably, oh, I see, John. What you're saying is that Tesla did a reverse split, and that's why that's doing that. You found it. That's it right there. Average, they've already made the split. So I need to adjust that on my current share value, number of shares. That's the one right there. So they did a 10-to-1, right? So I need to divide that by 10. That's the only one is that the only one I've got that did a NAV split? I think that's the only one. I didn't think they were going to do it till the end of the day today. So that was a 10-to-1, wasn't it, John? I think they did a 10-to-1 on Tesla. 5-to-1 on Tesla. So 10,416. It was a 10-to-1 on Ulti. 10,416.24 divided by 5. So that's 2,2083.248. That looks better. Now we're back to business. That's the only, they did Ulti and Tesla. Are those the only two? I thought that was the only two. Double check here. I'm going to double check real quick. Tesla. Where's Tesla? Tesla. Number of shares, 2,000. Yep. So I did it right. I did the math right. So we're back to normal because that's the only one they did. They did the Ulti and Tesla. I don't know why they did Tesla. Tesla was, well, I guess Tesla was down a little bit. So that's okay. So now we're back to normal. We started with 50,000. NAV is 80,000. Their website said 15 ETFs that they did splits on. I don't think they did they did very few of the individuals. Maybe they did Palantir. NAV only. That's the only one that looks screwed up on my list. Bitto. Oh, they might have done Bitto. Well, Bitto's not Yield Max. That's ProShares. So I'm okay. I think I'm okay. BD. Am I down on BD 42%? I think I am, actually. I got a couple. I wanted to also talk to you about tax loss harvesting and window dressing. All right. If we get a chance, we're going to talk a little bit about tax loss harvesting and window dressing. You know what window dressing is? I'm going to do a little window dressing. Show you how that works. All right. BD says that I have 447 shares. 447. So that's right. That one's not screwed up. Looks like the only one that was screwed up for me was Tesla. So, and we fixed it. So that's 2,000 shares now. Let's see, at an average cost. Did they change my average cost? Oh, they did. So my average cost went to 85.58. That sucks. All right. So now we're back to normal. That fixed that one. That fixed that one. I'll have to double check and see, but I don't think any of my others were affected by this. 1,002. Nope, that one. See, that one's good. 447. Oh, this one looks screwed up. Oh, no, that's right. 44, 289, 699. That's right. 8. NVIDIA? 699. What the heck happened? Oh, that's NVIDIA. I have NVDY. 5. NVDY. Misty. 8194. 8194 is correct. So NVDY, NVDY is 5467. That's correct. And then we got OARK, 35. That's correct. Palantir, 23. That's correct. Snoy, 42. Soxy. Where's my Soxy? Soxy. I'm missing Soxy. That's a new one I haven't got in there. It's tiny. I only have a tiny little bit of Soxy, but nonetheless, it should be in there. I got to add Soxy to my list. Do I have it in here somewhere else? Nope. I left Soxy off. Oh my goodness, I'm missing Soxy. That's the problem with using a spreadsheet. That's why we use Portfolio Matrix. Portfolio Matrix doesn't make these mistakes because it's programmed in. Tesla, MSTR. I have a little STRC. And Tesla, TSLY. And we're all straight. All right, my spreadsheet's good. It's just missing Soxy. But I only have like $2,000 in Soxy anyway. Yeah. Oh, no, I don't. I have $65,000 in Soxy. Okay, I'll get Soxy in there for next time. Can't do it right now. All right, so here we go. This is the distributions of my shares, sans Soxy. So we got 407,000. But if you come up here, you can see that I made 20,000 on the NAV. So I made the difference NAV only difference is I've made 94,000 on the NAV. So I've grown my NAV. Oftentimes when you're doing these yield first funds, you don't grow your NAV. Your NAV goes down. So I don't have a negative NAV. I have a positive NAV of about 20%. Now, if anybody looked at that, just that alone, they'd say 20% annualized return. Land Turner returned an annualized return of 20%. Look at my mug. You want to see the coolest thing ever? Look at this little mug. Can you see this mug? It's that mug that was on the internet of the White House. I'll show you the handle. The handle is it's a. Can you see it? The handle is a backhoe, and then the mug is the White House being construction. So it's on construction. It's funnier than heck. Everybody's having a freak out about the White House being constructed, and I'm just like, I saw this mug, and I'm just like, I got to get the mug of the construction of the White House. So I thought that was hilarious. So anyway, nonetheless, that's pretty funny. Everybody's freaking out about the White House being under construction. It's just another Washington building. Who cares? I mean, when was the last time you was in Washington and stood there and said, "Oh my gosh, they're doing construction on a building. I better be mad." You're told to be mad. Don't be told to be mad. Nobody cares. Nobody cares. Nobody cares. Plus, it was free. Nobody cares. Who cares? It's a building. It's a building. He's not hurting the original structure. He's building another Washington building. Who cares? That's my opinion. That's my personal opinion. Oh man, look at everybody unsubscribing. You like my coat? This is my little jacket I got. I thought it was funny. I thought it was really cool. It's a little red, white, and blue jacket. I'm a patriotic person. I love America. America. All right, here we go. Let's get back to the business here. So we got so this is my NAV. If you were to look at any portfolio and somebody said I made 220 annualized 20% return, they'd be happy with that. That would be awesome. I mean, the S&P 500 made what, 12%, 12, 14%, 13%, something like that on it this year. And on average, it might have been a little higher than that this year, but that's on average, it makes about 10%, 10, 12% on average. The NASDAQ does a little better. It usually does 12, 13, 14%. So you can see that my portfolio, just on the net asset value alone, because I manage my net asset value the very best I can, right? Oftentimes we say when you're doing yield first, you don't have to pay as much attention to the NAV, but you do. You want to have good NAV, and that's what we're going to talk about today. I'm going to go over and take you over to the software, and I'm going to show you how I manage my NAV. But then these are the dividends that came in. So then I got on top of the NAV, I had a 20% return on top of the NAV. So the difference here, the NAV only was 94,000. So I put in 480,000. My net asset value grew to 94,000 of a 20% return. Now I have my dividends over here. So this is my dividends, right? So then I have $392,000 in dividends. So when you add the NAV plus the dividends, I got 487,000. I put in 480,000. 487,000 is how much I made. Now, yield plus NAV plus yield is 66% return. So I've made a 66% annualized return this year. That's pretty good. I'm happy with that. Who wouldn't be happy with a 66% annualized return? Do you know anybody that wouldn't be happy with that? Be mad that they only made a 66% annualized return? I think that's pretty good money. All right. So capital in reinvested, it's 254,000. So I put 254,000 back in. Total capital invested 734,000. So that's my total invested. That's including my capital cost basis plus my reinvested dividends. All right. Now I've taken $100,000 out to develop our software program, Portfolio Matrix. So we developed Portfolio Matrix, and it cost me about $100,000 so far this year. So that's what we've taken out to develop the software. and that's where that's gone. And then we got 734,000 total capital invested. Now you can see over here, I want to bring you over and show you, these are just the numbers that I needed. This is the share value, the dividends, the quantity, and the average cost, and the difference. So that gets me my numbers that I can do the math over here. Now I'm not guaranteeing that this sheet is correct. I think I've got it correct. There might be still some errors in it. Still working on it. It's always a work in progress. This is my old one. If you remember, my old one was a lot more sophisticated, a lot more complicated. And I'll send you this one too. Anybody who subscribes to Pit News Magazine gets this spreadsheet, but there's going to be a new updated version coming out with the December issue. So you're going to get the new spreadsheet, which is Land's World spreadsheet right here. All right. So you get this one. I'm going to leave all my numbers in there. I don't care. You see what they are. You can see my real numbers. So you can take your numbers and replace them. You can see the ones that I don't hold anymore. I took all these out, but they still made money. So I still have to have them in there. So you can just replace mine with yours, and your numbers should come out to be something like this. And if I'm making a mistake in my spreadsheet and you guys are working on it, please tell me, let me know so that I can see it. All right, but this is the reinvested dividends. All right, so I want to show you something. This is kind of the key to yield first investing. So I've reinvested dividends, and I haven't done that great with my reinvestments. All right, I want to show you why I say I haven't done that great. So my quantity share, this is the money that I reinvested, not my initial capital, because you have to keep those separate, right? This is how much I put in the very first of the year, January. This was my cost basis. So coming January of this year, I'll have to reestablish my new cost basis based on all my blended money. So I'll have a new spreadsheet that starts January. So stick around and come and make sure you stick with me and come and watch how I do that. And then on January, I'll have a new cost basis for the year 2026. All right. So that's how that's going to work. And then we're going to come over here, and this is my reinvested dividends. So this is what money I put back in. You can see the quantities of shares. I reinvested the dividends. This is, and then get out of the way. Hide. So the current value, what we call drip. I didn't drip it though. I don't drip. I reinvest strategically. All right. So my profit and loss on this, you can see I reinvested $171,000. Can you see that? Maybe I need to make it bigger. You guys might have a hard time seeing that. How do I make it bigger? Can I zoom in? How do I zoom in on a spreadsheet? Find, select. I don't know how to make it bigger. I'm sure there's a way I can zoom in. I don't know. So, but you can see I put in $171,000, reinvested my dividends, and my net asset value of that is down 83,000. That sucks. I reinvested 171 of my dividends and I lost 83,000 of it. Why? Because I built an upside down pyramid. As the market was getting higher and higher and higher and higher, I kept reinvesting dividends higher and higher and higher, which was bringing my dollar cost average up, right? And those dividends, I track them separately than the original. So I know what my reinvested dividends are doing as a standalone investment. And you can see that I invested 171,000. I've lost 83,000 in net asset value because the market's come down and I had all my prices of those reinvested dividends way up here. Right? And so what happened is I lost to 28% of my money. 171,000 reinvested, lost 83, 28. But I did that knowing that I was going to get dividends, right? I was going to get dividends off of that reinvested 171,000. And I lost 83,000, which is sad. And I'm very disappointed in that. I lost 28,000, but my dividends, I made monthly $9,000 in dividends or 108,000. So I lost 83,000 in net asset value, but I made 108,000 in dividends. So when you total those together, I lost 28% here, but I made 37% here. So yield on dividends. So I ended up making 37%. So I lost 83,000, but made 108,000. So I'm still profitable, still made money. I'm not in the hole. I still made 37% return on my money. So that's pretty cool, right? So even though I lost 28% on the NAV, I made 37% overall because I made more money than I lost. on my 171,000. So that's pretty cool. That's how that worked out. So you can see each one individually. So if you come in here to AMD, I lost nothing. Well, 3% $3 is my reinvested. Let's do this one here. Bido. I put 38,000 in. I reinvested 26,000 and lost 41%. But every month I got 2,500 in yield, or $30,000 for a 46% return. So I still made more than I lost. I need to do another column that takes this number, subtract that number, so I can see that I probably made 41.6. I probably made about 5% total return on it. That's the column that's missing. I'll get that in there before too. So this one here, I lost 19%, but I made 20%. So I really didn't lose anything on this one. And I got 245 more shares. So if the market will just start going up and stop going down, these numbers will turn around, but they're not going to turn around by January. So you can see my yield covered all my loss. I didn't make any money. I did 83 to 108. So let's say 80 to 100. I made about $25,000 more than I lost. That's about right. I got another column I got to put in here. Let me finish that out before I put it out in today's Pit News Magazine. Pit News Magazine is coming out today. So for all of you guys who are waiting for your December Pit News Magazine, and for those of you who don't subscribe to Pit News Magazine, go over to pitnews.com, subscribe to the magazine, and you'll get this spreadsheet. It's still got some problems with it. You can see I'm still working on it. It's a work in progress. So, but I'll send it out to you. You guys can have it. I'm going to put these columns in here. So I got that one more. I think it should have two columns, the dollar amount and the percent gain total. But those are my reinvested dividends. So I reinvested 171,000 this year, and it was profitable, but mostly broke even. This is where my big money was, over here. This is all the big money, but it's all big money. It's all big money. All right. So that's my summary of my spreadsheet portfolio. Now, of course, this is all done for you in Portfolio Matrix if you don't want to manage a spreadsheet like this. But some of you don't have Portfolio Matrix, and so you need a spreadsheet. I'll send you the spreadsheet. But if you want to subscribe to Portfolio Matrix, it just does all this for you. Okay. So let's go over now, and I want to go over to our portfolio, and we're going to look through and see what some of the things are that we want to buy, because we're getting our dividends and we got a bunch of cash, and we want to see which one of these are good to be putting money into. The markets have been flushing back. Now, remember, we use a pairs system. So we do pairs. So we look at, if we're going to look at AMD, which is our pair, this is the one we trade, but we make all of our trading decisions on this market, but then we put our money into this market to get the dividends, all right, the yield. Now, why would you put your money in AMDY and not just into AMD? If you want income, all right, so the yield max is giving you a maximum yield along the way. So as I oftentimes put it, do you want little pots of gold every month along the way, or do you want one big pot of gold at the end of the rainbow? Because if you don't sell any of your shares, you're just going to keep accumulating and accumulating and accumulating over a long period of time, right? So that's the nature of the beast. So you'd be making a lot of money through here, but you wouldn't be realizing any of it. So that's realized gains and unrealized gains. So you have realized gains and unrealized gains. Now you pay taxes on realized gains, not unrealized gains. So if you put your money into AMD and you get your one big pot of gold at the end of the rainbow, you don't have to pay taxes on that big pot of gold at the end of the rainbow until you take it out. And of course, you're not going to take it all out at once, probably. So you're going to take out just a little at a time at the end of the rainbow, right? Just hope that you don't build up this great big huge pot of gold and then have it flush at the end of the rainbow, and then you got a little pot of gold and you got nothing along the way. There's advantages and disadvantages to everything you do in the stock market. All right, so hold on a second. I'm going to lose my voice. Okay, so the whole idea here is that AMD is the underlying stock. And so this is the one we're trading. And this is one we want to pay attention to for rebuying into this market. All right. And we want to do our best not to build upside down pyramids. So, as I mentioned before, what I did over here is I built upside down pyramids. So, although I didn't lose any money by building my upside down pyramid because my dividends paid off my losses on my upside down pyramid, that's my upside down pyramid loss. I built a $170,000 upside down pyramid. I always tell you guys not to do that. It's hard. I did it myself in reinvesting because you keep reinvesting as the market keeps going up. But then when the market flushes, you don't have to have the market fall very far because you're dragging your dollar cost average up, right? So I lost 83,000. Fortunately, I had dividends coming in and I made $188,000 in dividends. So I didn't really lose anything in here, but I didn't really make anything either. So would I have been better off to just not reinvest my dividends? Well, not really. I still made $25,000, right? 108 minus 83, still made $25,000. I still made more in dividends than I lost in NAV, net asset value. So it was still a profit. It just, I lost 83,000 in NAV. That sucks, right? So by paying attention to what we're doing over here, what we need to do is we need to do our very best in reinvestments or our very best investments to try and buy low. And of course, we don't generally sell these, right? Unless there's something wrong, we have to roll them. But we buy low and try and bring that dollar cost average down. Now, I've got in here, I've got the daunting channel. I'm going to turn that off for now. And I just want to show you, see, I've got in here a 200 period moving average. And so on these stocks, what I want to do is I want to come in and say, look, if the market's below the 200 period moving average, you can buy into this market. If it's above it, you're going to be building up an upside down pyramid. Does that make sense? Okay, if we kind of use that 200 period moving average as a guide, it simplifies all of this Fibonacci, Elliott wave, you know, Delta Kona probability, Donchian channel, mathematics. If you just kind of look at the AM, or just kind of look at the MACD down here in the bottom window and watch the 200 period moving average, you would look at this one and you say, well, I don't really want to be a buyer up in here. The problem is this market could pull back and then take off and go again, and you'd miss a great big run by saying, well, only the 200. So you have to take it with a grain of salt. But by looking at your technical analysis and understanding, well, there's drive 1, drive 2, drive 3. We got our little counter trend in here. We didn't get the ABC back like we expected to bring us back to the 200. All right. And it took off like a rocket ship again. Now we're getting the little ABC up here. The problem is this market broke this and we started to buy some more up in here, right? Which is what gave us the upside down pyramid. So we started reinvesting some dividends thinking, well, this thing's on its way up. And it may very well be, right? We may be okay. It's not going to, if it's too strong to ever pull back below the 200 period moving average, you'd say, well, I'm never going to get entered into the market. Well, that's not any good either, because you got to get some money into the market when you do reinvest those dividends for the next growth level, because this might come up, give us an ABC, and then go up on the next leg up, right? And then we would expect a little something like this, which is your Fibonacci bow tie in here. So you get your bow tie. That's what we kind of anticipate, that markets are going to move in these bow tie patterns, right? So that's kind of what's happening with this market here. So is this down in the pullback region? Well, from a Fibonacci standpoint, it is, but from a 200 period moving average, it's not. So right now, it's dead center of that Fibonacci sweet spot. We would tell you to buy right in there, right? We want to be buyers. Look how that thing came down and touched 61.8, just like a train on rails. See, I told you, the markets have a tendency, it's amazing. They'll come right down to these Fibonacci numbers. So it's like, why do you use a Fibonacci ruler instead of just a normal old ruler? Why don't you just say this is 40%, this is 50, this is 60%? Well, because the computerized systems that have been programmed, they've been programmed in with Fibonacci numbers. Why? Because they were told that they work. And so because they've been told that they work, that's why they work. It's like a self-fulfilling prophecy, right? But because they work, that's why they work. 61.8. That thing came right down to 61.8. It didn't come down to 62. Didn't come down to 60. Came down to 61.8. It's crazy, isn't it? I don't know. It's just self-fulfilling prophecy, in my opinion. But nonetheless, that's how these things are working. And so if you're waiting for it to come to below the 200 period moving average to get some more money in there, you're going to have a hard time. So that's why we use the Fibonacci ruler. And we say, try and keep in mind that when it gets back into this region here, this Fibonacci sweet spot off the major rally, and you're still anticipating a bullish market. Now, if you're anticipating a bearish market, which we're not in AMD, AMD is really doing well. And of course, we could go over and look at our, we could come over here and look at our little fundamentals, right? So we can come in here, go AMD. Do we believe AMD is a good company? Well, we're going to come down here and find out. Well, in sales in billions, yeah, they're making money. Look at that. It's going up, 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 up. The earnings per share, there's outstanding shares staying constant. This is all good. What's their sales this year? 32 billion. Last year was 25 billion. Yeah, they're making money. They're going to outperform last year. They're at 32 billion now. They've still got a month left to go. And they've got 25,000 was the max they made last year. So yeah, they're kicking it, right? They're doing really well. So you can see that in this little FinViz window. That's what this stuff here is. And you're like, well, Lan, I go to FinViz, mine doesn't have that. Well, you have to subscribe to get this little table right here. You get all this, and you get all this, and you get everything else. They just don't give you this little table, these little tables right here, unless you pay for it. But if you want, and you don't want to pay for it, you just say, Lan, pull up AMD, and I'll show you this little table. That's the part you don't get. I don't think they'll get mad at me for doing that. Okay, so now we come in here and we come back over to our that's AMD. Do we want to put any more money into AMD? Well, right now, if you anticipate a rise in price back here, it would be a good buy spot, but it's above the 200, and the MACD hasn't pulled back down into the lower region. So this is saying that yes, if this market continues to be bullish, but it could also be, obviously, it could also be bearish. All right. And this is saying that it's got a lot of downside potential down in here. But now remember, we're also in the month of December. So you guys are going to get your Pit News Magazine. I want to make sure you read your seasonal nature of markets in Pit News Magazine. It's got some really good information in there on why December is so sporadic. And we're going to have a lot of tough times going through this December. So be very mindful and be very careful and be very watchful of your accounts, and don't freak out. Don't panic sell in December. The reason December is always such a hard month is because of the tax loss harvesting and the window dressing. All right. Tax loss harvesting, of course, means that let's say you made $10,000, and somebody said that they were in class the other day and I wasn't clear on how that works. So let me see if I can clear it up. You made $10,000. All right, in your market, in your net asset value, your stock grew $10,000. Well, if you don't sell it, that's unrealized gains. You don't have to pay taxes on anything that are unrealized gains. So if the NAV goes up, let's go back over to my example here. All right, I've got in here 19% return on my money. And a 19% return on my money is $89,000. Now, I didn't sell any of those throughout the whole year. I kept them all through the entire year. Now, I did do some rebalancing, but that was mostly down here. You can see the ones I rebalanced. But for these, I didn't sell them. So that means that $89,000 or 19% of my portfolio, I don't have to pay taxes on it because it's unrealized, right? As soon as I sell them, I will realize the losses. But right now, or the gains. Right here, you can see that I got NAV only. I'm down $15,000 on that one. But it's a $15,000 loss. I don't have this one's got a $29,000 gain. So obviously the gain of this one offsets the loss of that one. But this one here is a $29,000 gain, and I got a $15,000 loss on this one. But both of those are unrealized, meaning that I haven't sold them. Therefore, I'm sitting on the loss and the gain. I won't pay taxes on either one because they're unrealized. It's not, you don't have to pay taxes on them until you realize them. How do you realize them? Sell them. If you sell them, then you realize them, and then you have to pay taxes on them. Well, what are we doing along the way with dividends? We're selling them. So we take our dividends. So all of our dividends, see that $482,000? I'm going to have to pay taxes on that. I'm going to have to pay taxes on $482,000 because those are dividends that came to me. We sold them. It's profit. I made it. I took it. It's there. It's mine. Hey, you took $482,000 out of the market land. You're going to have to pay taxes on $482,000. So in the month of December, what I can do is I can sell some of these. I can sell 15,000. I can sell 5,000, 27,000. There's 3,000. There's not much there because I made $86,000. So I got $479,000 of both NAV and dividends that I've actually it's $392,000 of dividends. So I got to pay taxes on 392,000 plus 86,000. I'm going to have to pay taxes on $479,000. Well, I don't have enough money to pay taxes on that. Where's it going to come from? I'm going to have to sell some shares to pay the taxes. So what I'm going to do is I'm going to sell some shares in the month of December. And if I'm not the only one doing that, right, I'm going to sell some of these losses so I can take that $15,000 loss against my $470,000 win. That's unrealized, and so I'm going to realize it. I'm going to realize that loss of $15,000. So I'm going to take that off. And of course, I'm going to talk to my tax accountant to make sure this is what I want to do, because you always want to talk to your tax accountant, okay? Because I'm no tax accountant. I don't know. The last time I did a tax, filled out a tax form, a federal tax form, was a 1040 EZ form. I don't do my own taxes. I got people that do my taxes. I don't do it. I just manage my money, and then I go talk to my tax accountant, and he helps me do my to manage my my funds so that I pay the least amount of taxes. But we're going to have to do some tax loss harvesting. So I got a meeting with him in December, and we're going to decide how to do this to maximize my profit potential and to reduce my taxes. But what I'm going to have to end up doing is I'm going to have to sell some of these losers. So I'm going to realize the losses against my gains. If I don't realize them, then I'm going to have to pay the full amount on 479. So I got to realize some of these losses. So I got to sell them out. So there's $28,000 in Misty. I could sell off Misty in December, and it would realize my losses right against that 28,000 against here. I wouldn't have to pay tax on $28,000 worth of income over here. Now, what got confusing in class is I said you can only write off $3,000, and that got confusing. I had somebody say, I thought you said you could only write off 3,000. Well, it's only 3,000 of a loss. Now that's not a loss. If I write off 28,000 against 479,000, I still haven't lost any money. I'm still making money. So if I write off all these losses, I'm still profitable. But if you had losses, if your account was at a loss, so for example, you made 10,000 but you lost 20,000, and you write off your unrealized $20,000 loss against your 10,000 gain, well, you lost $10,000, right? You actually had a $10,000 realized loss. Well, you can only write off 3,000 of that $10,000 per year. So it's going to take you 3 years to write off that $3,000 loss for the next 3 years. So I know it gets a little confusing, but that's the way it works. Okay. So you're only allowed to write off $3,000 in losses in the stock market per year. So if you lose $20,000, you only can write off 3,000. And that's what I was trying to say in class. One of the students said it was confusing. He didn't understand. But I make 479 here. I lost 15,000 here. I sell that, realize that loss. It goes against my 479. Now I don't have to pay taxes on 15,000. There's another 28,000. I could sell that, realize the loss, and it would go against my 479 profit, and I wouldn't have to pay taxes on $28,000 because that 28,000 is going to go against my 479,000. Does that make sense? Now, if I had more losses over here, if I made $479,000 and I lost 500,000, well, that would write off. I would realize the $500,000 in loss against the 479, and I would still have $20,000 of losses greater than what I made, right? So I lost 20,000 if I had lost 500,000 here. So that would end up with 20,000, and I could only write off 3,000 of that 20,000. Now I'm not in that situation. I just have all these little losers right here that I could write off, which is going to save me some taxes. But I have to decide if I want to get out, right? Because if I get out, now I have to stay out for 30 days. And how many dividends am I going to miss by getting out? Do I just want to go ahead and pay the taxes on that $15,000? Because I'm going to have to do the math. What are the dividends? What are the taxes? Are the dividends going to outperform the taxes? Is it going to be worth selling it and getting out of it just to save a couple bucks in taxes? Because taxes are, it's all math. So I don't do it. I have a guy that does it for me. So we're going to meet in December, and he'll tell me how much to sell, and I'll probably sell some of this or not, depending on what my dividends are. I'll probably try and do much of the math myself first before I find out. I find out what my tax rate is, and he'll tell me, and then I'll decide if I want to sell some of it or not, or hang on to them and realize them or realize them next year. Now, what's window dressing? Window dressing is that I'll show you a window dressing. I have a one I put a little tiny amount in. Chippy. Look at that. I put $2,600 into Chippy. That's all it is. It's a little tiny $2,500. But look, I lost its current value is $2,400. I've lost $155 or 6%. Grand total dividends has only been $61. I'm down $94. So overall, my yield plus gain, I'm down 4%. I'm losing money, right? So I'm not making any money on Chippy, and it looks bad on my portfolio. It looks bad. So when I pull it up and show you guys, you're like, oh, Land really did a stupid thing there, didn't he? Where's Chippy in here? And I'll show it to you. Chippy. Look at where Land bought into Chippy. Right here. Land bought in at that average. That's my average cost on Chippy. So I did a really stupid thing, right? I bought at the very top of that thing. Now I thought it was going to make a 3-drive pattern. I thought it'd go up, a little counter trend, up. I thought we'd get a little counter trend and up again. So I was looking for a 3-drive pattern, and it flushed out with the rest of the market. The whole market flushed out. Now, could it turn around and start going back up and be profitable? Yeah, I think it will. I think Chippy is a really good company. It's not one company. It's the semiconductors. So there's all kinds of semiconductors in there. So the chip company, that's why they call it Chippy, chip manufacturers. So is it going to go up? I think it will. I think that, and it's only $2,000, but it looks really bad right there. All right. And this thing came all the way down to almost 50%. So it lost 50% of its value after I got into it right at the very top. I couldn't have got into it worse, in a worse location. So buy the valleys, not the rallies. And that was definitely a rally, but I thought it might go up a little bit more in there. I thought that might be the first drive of another little 3-drive pattern. I thought we'd be going up like this. But it flushed harder than I anticipated. But that's why I only put a small amount of money in. So anyway, I got a really bad one in there. And so I could window dressing, I could take that off, remove the 2,000. It would realize my loss, right? Which would be good for me. I could realize the loss, $155. I wouldn't have to pay tax on $155 if I window dressed that one. So take that out of there so that when I show you guys next time, that's why they call it window dressing, you don't see that I picked a really bad. I wasn't really bad at my entry. I didn't have a really bad entry. Does that make sense? That's called window dressing. And portfolio managers do that all the time, because it serves two purposes. One, they get to take the loss off, and so they don't pay taxes on it. And then number two, it's ugly in my portfolio. And so next year when I show it to you, I don't want to show you that I'd made that bad, ugly mistake. That's why they call it window dressing. All right, so that's that. So let's come over and look and see if we can find a stock that we might want to put some money into, because we got a bunch of dividends sitting in cash, and we want to decide where to put them. Here, let's got to pull up Track and Trade. All right, this is Track and Trade. This is the software that I use to manage my portfolio. If you guys are not familiar with Track and Trade, just real quick here.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so now we're going to go through and look at the individual stocks that I have in my portfolio. These are the ones I have in my portfolio. It's not all the ones in the Yield Max funds. We'll go look at the Yield Max list so you guys can see where to get that, because we have what we call discovery and we have management. All right. So discovery for the stocks that you want to put your money into, and when you want to put your money into it, I use Track and Trade. Track and Trade is my discovery. That's where I sit here and analyze all the markets. It's a technical analysis, amazing technical analysis tools, the Ferrari of technical analysis trading. It's also got the ability to be trade. You can use it to buy options, and you can do all of your trading right in Track. It's an amazing tool. All right. It's a really cool tool. So that's the one I use to do all my discovery. Now, management is not done here. I don't manage my trades over here. I manage my trades in Portfolio Matrix. The reason we had to write Portfolio Matrix is because none of these brokerage firms, like Track and Trade, is hooked up to a brokerage firm, and the software doesn't do portfolio management. None of them do. If you're in Robinhood, they don't do portfolio management. If you're in Fidelity, they don't do portfolio management. If you're in any of them, I don't care which one you're talking about, they don't do portfolio management. They just do brokerage management. All right. They're all just a bunch of brokerage firms, and they give you charts and they give you the management of your account. They show you how much money you're making and stuff like that, but they don't do portfolio management. That's why we had to write Portfolio Matrix. So Portfolio Matrix is a portfolio management tool, and that's what this software does. It manages your portfolio once you have a portfolio. But Portfolio Matrix doesn't do discovery. So you have portfolio management and you have portfolio discovery. So the brokerage firms, their software, pretty good for portfolio discovery. Now, some of them, I mean, Robinhood sucks for portfolio discovery. The reason we like Robinhood is because they're just a tiny little app that works on your phone, and you can see what your orders are, and you can place them really easy, and you can look at your stuff. It's not good for anything else. It's just why it's good. It's free. So you have to do all of your discovery in some sort of a trading platform. So that's why I have this platform. So you come in here, and we can look down through, and we can do all of our technical analysis. We can pull up all of our portfolios. We can create 1 million portfolios, all kinds of stuff for discovery. But once we've discovered what we want to trade, we track it in here. That's what's called track and trade, right? You have your track and trade software to track it and trade it and discover it over here. But then once you have it, you manage it over here. This is where you see your gains and your yield and your losses and your gains plus your yield. And then you can see all of your dividends, and you can see all of your stuff is over here. This is where you manage it. And then, of course, it's also got the performance and then the rebalancing. So it's got the portfolio rebalancer. So when you get new dividends, you can rebalance your portfolio and put your money back in. It'll tell you where to put it. But I don't always want to put it back in evenly against the entire portfolio. So if you go into Portfolio Matrix, and some of you have Portfolio Matrix, and you pull up your portfolio, it'll show you everything you got in the portfolio. You go into the if you go into the My Performance or into the calculator, it'll tell you to take, okay, I've got $10,000 in dividends. Where do I put them into the market? It will tell you all those against each other, right? Now you can go in and remove some. Say, well, I don't want to put any more into Misty because it's flushing like a toilet. Okay, we'll take that one out. So you can remove that one, and it tells you how much money to put into each one for maximum profit potential. But I want to also not put money into some markets because I don't want to build an upside down pyramid. So I need to know which ones I want to put money into and which ones I don't. And then I'll go in and I'll say, okay, take this one out, take this one out, take this one out, and tell me how much money to put into the leftovers. And then that's where Portfolio Matrix will give me the maximum profit potential of getting into certain markets. But I have to make that decision. All right. If I just tell it to just put it across my entire portfolio, it will. And that's great. That's wonderful. If you want to do it the easy way, just do that. But I want to sometimes not build my upside down pyramid. I'm going to try and do better in 2026, not to have a window that looks like this. All right. All of my reinvested dividends just ended up, I mean, I made money. I can't complain. 108,000 against my 85,000. I still made $25,000. All right. $25,000 you can't complain about, but I can complain about losing 85,000. So I'm going to try and do a better job now that I've got Portfolio Matrix and doing it my way too. I can do a combination of the two, and I can do much better. So in 2026, my goal is not to reinvest dividends and just lose it all. So I'm going to come in here and this is what I'm going to do. So AMD, it's above the 200% period moving average. Let's go see if there's not something that I can buy the dip a little bit better. Now, this is in a dip. It's just not clear below the 200 period average. And it does look like to me there's some downside potential. But it's a strong stock, and it could take off from right here. So we could put a little bit in there. We're just not going to back the truck up, right? So if we wanted to put some in there, we wouldn't put it into AMD. We'd put it into AMDY, which is over here, and it's under the 200 period moving average. And you can see that my average cost on AMDY is this line here. So it's really close. If I wanted to put some money in here, it wouldn't hurt my average price all that much, right? So my average price wouldn't be hurt because the market's pulled all the way back down to my average price. And it's below the 200 period moving average on AMDY. So you have to take that into consideration. And that's what we're talking about when I look at this market. I'm not going to be looking at this market for all of the 3 drive patterns and all that stuff. Not that it doesn't have them, it certainly does. Let's get rid of the Donchian channel to less confusion. We're going to use the 200 period moving average, okay? And you can get rid of the parabolic SAR too, which is the 3 drive pattern. All you're going to really look at is where is my, on this market, all we're really concerned about is our dollar cost average, our average price, because that determines whether you made money or lost money over here on the spreadsheet, over here in this reinvested dividends. So if it's below, the way I'm doing the math in here is based on the average price of the shares I own. So that's what determines that profit and loss, because that's what the brokerage firm determines it on. So if we come back over here, oh wait, that's not where I want to go, right here. You can see that my average price is right here on AMDY. Okay, so I'm in pretty good shape there. I could put some money into that one, and I actually think I did. So we're going to come down to ARK. Our ARKK is Kathy Wood's fund. Now this is a diversified fund in here, and it's making a 2 drive pattern. So if this thing comes down, we could come down into the Fibonacci sweet spot down in here, which would be below the 200 period moving average. But you can see the MACD's already come down way deep in here, but it's turned red and it's starting to go back up again. So that means I got these reversed. Let's go back over here to TNT default. There we go. I was playing with doing it backwards, right? Remember in class. So we come over here, see it's gone green, which means you can buy, but it's a buy signal above the 200 period moving average. So it's a very cautious buy. All right. And that's on ARKK, because we could get another flush down here into the Fibonacci sweet spots, which is down here. But if the market takes off and starts to show strength up there, it could go up. So that's why we'll buy a little bit in here. You can put a little bit in here right at 38.2. And that's where that's at. And that's what that's saying right there. But if you notice back in here, see, this has got a little camel hump in it like that. All right. So it came down, said buy right here, but then it went down farther. And then we got another buy right here. So this is your buy signal. This is your buy signal. So this is your buy signal. This is your buy signal. Now this one was a better buy signal. Okay. Now this is why it's called MACD. MACD is the moving average convergence divergence. This is very important. All right. Very important for you to understand convergence and divergence if we're going to be using the MACD. Notice that we have what we call lower lows and lower highs. Okay, so we have lower, see this low, and then this low. See how this low is lower than that low? All right, very simple stuff, right? This low comes in with this low. This low associates with this low. But yet this low is lower in the market, but it's higher on the indicator. See how the indicator shows a higher low, but the market shows a lower low. That's called divergence. All right. That's why this is called the moving average convergence divergence. So if it's converging, what you're going to have is you're going to have lower highs and lower lows in the market, and you're going to have lower highs and lower lows in the indicator. But if you get lower lows in the market and you get a higher low in the indicator, that's called divergence. And that's an indication of a reversal of the market. And this one did. This one reversed right at the divergence. Okay. See how that diverged? This is having higher lows and the market is having lower lows. And so when that happens, that's called divergence, and you anticipate the market having a rally. Okay. So that is convergence and divergence. And you can get that in many of these indicators. So for example, you can get divergence in a stochastics indicator. So you get an indicator that's giving you higher highs, but the market's giving you lower highs. That's an indication of a topping formation. All right. So you can get these convergence and divergence in many of these oscillating indicators that are based on a 0 to 100 scale. And so MACD, though, in particular, is called moving average convergence divergence for that purpose alone, just to show you that's a strong signal that the market's getting ready to reverse. Now, what we're looking for here is maybe the same pattern. Is it going to happen? We don't know. But it's getting a nice low here. If it drops one more time and comes down here, you're going to get the possibility of a higher low, which would then be the reversal, and we would get that divergence, right? And anticipate that would be the bottom, and away we go. We'd back up the truck. All right, so that's convergence and divergence on the ARKK. So now we're going to come down to OARK, which is the pairs trade of this. This is the yield max version, the dividend version. And you can see for me, if I get rid of all these drawings in here, let's clean this up, delete all arrows, and let's remove the Donchian channel. So you can see that I got my 200 period moving average, which is coming down here, and OARK is below the 200 period moving average. And you can see that my average entry price is way up here. So if I bought down here, it would pull my average entry price down, or do what? Pull my pyramid down. So I would then start building a stronger base for my pyramid. Right now, I got kind of a, you can see I got kind of a not an upside down pyramid, but it's definitely not a strong pyramid. All right, it's not a strong basing pyramid. And this, where this market's clear down here, and you can see way down in here, it looks like to me we got a little buy signal right there, but it looks like the market wants to go down just a little bit further. We may get that second leg. So, but this would be an okay place to be buying into OARK right here for me, because I've got my average prices right here. And that would pull my average down, helping me build a strong pyramid, not an upside down pyramid, which is a weak pyramid. Okay. So that's how I am on OARK. So what I would do is I would make sure that OARK is in portfolio matrix on my rebalancer. So on my rebalancer, I would put OARK in, and I would take AMD out. I don't want to be putting any money in AMD. It would make my average price go up and build an upside down pyramid. And then that would make my spreadsheet show that my reinvestments were losing money, not making money for me. Okay. More likely that I would lose money than make money in that situation. So I take that one out and put this one in. So now we got BD, same thing. See, I did a really poor job of getting into BD. I started building in my BD position here, and I build an upside down pyramid. Now the market's way down here. I should be buying BD, but it's a stupid Bitcoin. Bitcoin it's being manipulated right now. I didn't think Bitcoin could be manipulated, so they say. But JP Morgan Chase is fighting with Misty, MSTR. And JP Morgan Chase is trying to drive Misty out of business. And so they're doing it through the process of, if you didn't think these markets were manipulated, I got a bridge to sell you. But I didn't think they could manipulate Bitcoin as easily as they are. And they're manipulating Bitcoin. So Bitcoin is being manipulated by JP Morgan Chase because they're having a fight with MSTR. They're trying to drive MSTR out of business. So this may be an opportunity for us to buy Bitcoin, right? I mean, it's getting beat up pretty bad, but I don't know how much further it can be beat up. It can be beat up a lot more. That's the problem. So this is down 1, this is counter trend, this is down 2, counter trend, this is down 3. So we got a full 3 drive pattern going down off the top of this Bitcoin BD fund. Now we're getting a buy signal right here, okay? But there's no reason, I'm not anxious and in a hurry. I don't have to buy a falling knife. This thing right now is considered what we call a falling knife. It's coming down. I can wait for it to make an ABC head and shoulders formation, right? So I can wait for it to come in and give me a pattern like this. I can wait for it to start to rally because I know it'll probably pull back against that rally, and then I can anticipate the next rally up, and that's where I can be a buyer. So I don't have to get right here. I don't need to get the head of the head and shoulders. I'm fine with the right shoulder. That's where I like to get in, is on the right shoulder. And then that might give me a better MACD down here, right? It might come up, come back down, and we'll get a little bit of convergence on the upside, or we might get some divergence, right? We got a little divergence here, divergence here. This is actually convergence. So you're getting low, a low, and a low, and we're getting a low, a low, and a low. So we might start looking for and trying to find this pattern here that we saw back over in here too, even on Biddy right in there. See that? So we got the low here, and then we got a low here, but this is a higher low. That's a good buy spot. We haven't seen that over here yet on Biddy. So there's time. We don't have to feel like we have to jump into this market. And it would be nice to, once it does start to show that these guys are starting to head back up, we could start to pull that average price down. But see, that's when I could window dress too. I could take that off and get out of it. And then when I showed you guys that, I wouldn't show that I had a really bad entry. And then that would be window dressing. And you say, oh, Land's so smart. He doesn't have any way up there. Well, it's because I window dressed. I took it off, used it as a used it to reduce my taxes because it's in a loss, and then put it back on down here. I take that loss in between, don't pay taxes on it, but it's still a loss. And then when you see it, you see that yellow line way down here, and you're like, oh, Land's such a smart trader. I want to be like Land. Window dressing. All right. So here's the next one. If we go back over to my portfolio, see, we got some of these in here. Let's come in and see Bitto is the same thing. It's just like BD. BD and Bitto are, again, BD has Ethereum in it. So it's Ethereum. I got too much into Bitcoin. I got way too much into Bitcoin is the one that's killing my portfolio. I mean, my portfolio is doing well. I can't complain. I mean, I'm making a lot of money, but the losses are coming from these Bitcoin ones. So, but last year Bitcoin made me a whole bunch of money because it was going straight up. So this year I'm giving it all back in this year. So, but BD is Bitcoin and Ethereum combined. Bitto is just Bitcoin, but this is a Bitcoin ETF. And if you come and look, let's go look at my flush to heart again today. Nasty, ugly market. So BD, Bitto, I got 35,000 in Bitto. My NAV only 64, NAV only difference. Well, it shows I'm making money on Bitto. I can't see that. I got to check that. Wow, did this one split too? It's showing I'm making 83% on Bitto. And this is Bitto. I don't know where my average price is on Bitto. Bitcoin strategy ETF. I can't be making money on that thing. Look at where this is at down here it's the same here. It's like that line down there. Ugh, look at that today. Oh my gosh. This stupid Bitto. I'm just feeling sick about it. And I don't think that's right. It shows I'm making money on Bitto. Can't be making money on Bitto. Let me go see how much. Bitto's probably got a screwed up something in the formula too. Bitto. Yeah, something. Oh, they must have. Where's the shares? No, I got the right shares. What's my average? That's the dividend. Current share value. Average cost. That's correct. Share quantity. That's correct. How come I got something's wrong with Bitto? I gotta look at Bitto. I am not. I think I'm down on Bitto. Wait, how much have I? Oh, yeah. See, it shows 124. I'm actually up only like. I'm up only like 2%. I'm breaking even on Bitto. I'm not losing money, but I'm not making 124% either. That's something screwed up. I got some errors in here I got to fix, probably because some of the splits. I got mistakes. All right, we'll go fix them. We'll fix them. All right, Chippy. So that's Chippy. We already talked about Chippy. Coin. So this is Coin. Land's most advanced class this week. Well, that's because we've been teaching new classes down at the university, and so we've been kind of keeping it simple and for the new guys. But this one, we're starting to get a little bit into some of the deeper stuff, that's for sure. All right, hold on a second before I lose my voice. All right, so let's go into the next one. That's Coin. Coney, again, Coin is another stupid Bitcoin ETF. I made so much money on Bitcoin last year. I just kept all my money in there, and this year is getting all flushed back. But at least my entry point on Coney isn't so bad. See, that's my average price on Coney. It's currently trading at 450. I'm in at 716. So you can see that that's where my average price is. It's down here. So again, I could come in here and I'm getting my first little wave pattern in here. And it's right there at the same spot, but we got some others down here. Look at these. So we got some downside potential on this thing, but this is Coney, and that's coin. So we got to go look at coin. This is the one. What's coin's doing? So coin is down here at 61.8 right now. Now Coinbase is a clearing firm for people who trade Bitcoin. So they're not actually Bitcoin. They're like the New York Stock Exchange for currencies. For not currencies. They're like the New York Stock Exchange for cryptocurrency. All right. All right. So that's Coney. I could be buying some Coney, but I'm not anxious to be putting some in Coney yet. Hood. So this Hood is Robinhood. So some of you guys have Robinhood as your brokerage. You have your money in Robinhood. This is that brokerage firm. Now, the reason they took off so big is because so many people are started to trade currency or crypto, and they started to be an exchange like Coinbase. So Coinbase and Robinhood do a lot of the same thing, right? So Robinhood does stocks as well, but now they also do crypto. So you can trade crypto on Robinhood. You don't need Coinbase anymore. You can just be in one. So that's kind of what drove this market up crazy like this. So they're doing really well. They haven't pulled all the way back into the Fibonacci sweet spot yet. And again, we've only got one bump down here. We don't have the second. This one, see this? Now you can see your divergence right here. Again, a low and a lower low down here, but yet we got a low and a higher low on the indicator. So that's a indication the market's turning around, going the other way. We haven't got that over here. Of course, that happens up here too, right? Oftentimes you'll get the divergence on the top for a flushing market. And so we got a big one here and a little one here. This didn't go up higher than this one, but it was close, like a little double top. Yet this one was really weak. So that's the indication. That's why that market's, not why it's flushing, but it's an indication that they're anticipating a flush in the market, mathematically calculated. So now we're down here looking for the reversal. So there's our first from green to red. So that's why you're getting a little pullback. But are we going to get the second one? I think we will. I think we'll get a little run up here. Then we'll get another one here, and then maybe that's where we'll get that little bounce like that, and we'll get a little bit of divergence down here in the MACD, and we'll see that down here in the Fibonacci sweet spot. That would all be kind of converging at the right spot, and it would be happening in December when everybody's kind of doing their tax loss harvesting and their window dressing. So that's why December is going to be a tough month. So look forward to December being a tough month. And then January, February, March, we should come out of this thing like a rip-roaring, snorting wild man. So be ready for that too. Okay, look for the first quarter of the year to be really good. So there's Hoy. So you can see my average price is at 68 on the Hoy, and it's way down here, and it's at a buy zone. So could I put some money in there right now? I could. It's the first buy right in there, green to red, right here. We could put a little money in there, but it looks like it wants to come down to a third drive. We've only got one big, huge drive down here, but we don't always get two bumps like that. We didn't get it here, but this is drive one, counter trend, drive two. Is it going to go into a third drive? Well, we have to look at Hood and say, well, what do you think? Yeah, I think it's going to come down one more. I don't know. I don't know what it's going to do. I'm just saying these are what the probabilities are. The probabilities say that we might see this thing down into the Fibonacci sweet spot. It might bounce off of 130.9 and just stay right there and go up from there, go sideways or something. But remember what our little map says too. We look at our map. If we look at our map, now you don't use your map on the yield max funds. You only use the map on the actual stock. So pretty much like a train on rails, this is where we're at right now. We're in this first run right here, right? This first dip. So we're going to expect this market to kind of go sideways right in here. But then it says there's one more to go. You could get one more down in here. Does it mean it's going to do it? Not necessarily, but this is the map. And that's kind of, it's been following it pretty well. You can see all this right here looks just like this. You got the accumulation stage down in here. You got the rally. You got the top up in here, a little double top, just like we've drawn on the map. And then we got the first flush, and you can see right where we're at in the map right there. Are we going to get that one more down here? I think so. I think we will. It's going to be painful. Yeah, it's going to be painful to sit through it. But you're going to get dividends, and it'll help you cover the losses, and you just have to sit on it. That's nothing else you can do. All right? Okay, so there's that one. Now let's go to MSTR. This is another one that's killing me. Very painful because I own Misty. I have a lot of Misty. Where's my average on Misty? How come I don't have an average price on Misty? What's my average price on Misty? So I come over here, Misty, average dividends, share, average cost, Misty, 27.13. Look at this. 27 right there. It's about as close as I'm going to get it. That's my average cost on Misty. Ugh, way up there. See, I was feeling good about it because I was like, oh, I'm smart. I'm smart, laying smart right here. I got in right here. This is where I got in on Misty right here. And so all of this, I was making money hand over fist, right? Both the NAV and the growth. And then even this, I was not worried. I was like, oh, I'm not worried. I'm making so much money on the dividends that I don't worry that the NAV's down a little bit. But I didn't keep putting any money back in. I could have put money back in, which would have drawn my dollar cost average down. But I'm glad I didn't because look at this. I'm still getting dividends, and I'm not losing any money on this market, believe it or not. I'm still making money on Misty because the dividends are so big that that they cover the loss on the NAV. Even at this point, my dividends are still covering the NAV loss. But it's not fun. I mean, this is not fun to ride through. I'm telling you that. I'm pretty disappointed. And where's it going to stop? Nobody knows, right? Spin the wheel. Where's it going to stop? Nobody knows. The stupid JP Morgan Chase is trying to beat up Misty. And right now, they're winning. All right, here's NVIDIA. And we got NVDY. So where's my average? That's my average on NVDY. Not too bad, but it could be better, right? So the NVDY is one I could put money in. I'm very bullish on NVIDIA. I think it's got a great future. Big company doing well, selling all the chips to AI. It's the Levi's of the gold rush, right? Selling Levi's to all the gold rush people. So if we come over here, and we look at, just for fun, we could pull up NVDY in Portfolio Matrix. And the gain is down 43. Well, that's from here. It kind of settled out here in May. So it's down 43, but the yield is 73. Still making a 30% annualized return when you combine those two. If we go 6 months, so the yield, the gain is 9. So if you double the yield for the whole year, that's 60% annualized return with a flat gain, 9%. You'd be a lot higher. You'd be doing better. I was just discounting this, keeping the yield, but discounting the growth dip, that big fall in growth. And then see, they kind of settled out and just started to go sideways. That's what you want to see. And these yield max funds, these high yield Granite share funds, those funds, you want this thing just to go, you want that bottom blue line just to be flat. If it was just a flat line, you'd be happy. You'd be dancing in the street. Just a flat line's all we want. All right, because that's giving you your maximum yield against the growth. But the yield on this one, the growth has been down 43% because of that drop out of the beginning. But if you discount that, that's this turn. See, I didn't buy it back here, so I don't have to take that big loss into consideration. So that's that one. Let's go back over to, and so you can see I'm underwater on my average price. My average price is $16.58, and it's currently trading at 14. So I've lost some on the NAV, but the yield is paying it off. So let's look at Palantir. Palantir is my best one. Palantir, my spreadsheet's got so many bugs in it. Can't trust it anymore. I don't trust it. Too many errors. There's Palantir right there. So Palantir, I put 80,000 into Palantir. Current value is 126,000. So I've made 46,000 or 58% on my Palantir. That was a good trade. That's really good money. And then my dividends during the same period of time, I made $76,000 in dividends. I put 80,000 in, made 76,000 in dividends. It's this one stock that's really making my portfolio sing. All right. So, and that's generally the way I found it is. Usually you've got one or two or three stocks that really do well for you, and then all the rest are kind of just hunks of clay that are hanging on for dear life. So it's the 80-20 rule. 20% of your portfolio generally makes 80% of all your money. So that's that Palantir is a good one. Put in 80,000, it's up 126,000. So I've made $46,000 or 58% return on the NAV. And then I got $76,000 in dividends. So NAV plus dividends, 122,000. Does that equal out? Does that sound about right? Am I doing my math right on that one? That looks right. And for a gain of 154%. So that's cool. I only put in 80,000. And when you add those two together, I got 122,000 for 154% return. Can't complain about that, right, guys? Can't complain about that. All right. So capital reinvested, 67,000. And then capital total investment is 147,000. So I've reinvested 67,000 of the 76,000 that I took out, or that I took out as dividends. I put 67,000 back in. And then if I come over here to Palantir, my dividends that I put in, I got 1,000 shares, 57,000. That gave me 1,000 shares. Now on the reinvestment, I'm down $9,000 on the NAV. So I lost money on my reinvestments because I kept putting it in higher and higher and higher. So I lost 14% on my reinvestment of 57,000. But in the meantime, I made $33,700 in dividends. Oh, per month. So I made $44,000 in dividends in that period of time. So I lost 9,600, but I made 44,000 on the NAV, net asset value. Went down 9,600, but I made 44,000 in dividends on my reinvestments. And that was a 66% return. I'm going to check these numbers because I think I need two more columns. All right. So that's Palantir. Palantir's been my best one. That's why I made a lot of money on Palantir. It's kind of rescued me. And what I did is I took a lot of the money. I took a lot of the money from like Misty. So I wasn't reinvesting back into Misty. So I take the money from Misty and I put it into Palantir. So now you get blended money, and it's really hard to keep that all straight. That's why you have to have on January, you'll start with a new cost basis, and your cost basis will take all that into consideration. So you're going to say, well, how much do I have in Palantir today, blended money on January 1st? And you'll take that number from your brokerage firm and you'll put that in as your new cost basis. And it's going to take all those losses and profits and all that stuff. It's going to take that all into consideration, blend it all together, and you end up with a new cost basis. And you start the next year with this new cost basis. All right. So all that blended money just becomes a new cost basis. All right. So that's where we're at with Palantir. So we're going to go look at Palantir PLTY, and you can see my average cost is at 61 and it's currently trading at 53. So that means I can, when I do my averaging with Portfolio Matrix, this will definitely be one that'll be in the market. I'll be putting money into this one because it'll pull my average price down, right? But I want to make sure that I want to be putting money into Palantir. What did I just do? I want to make sure by looking at this one, does it have more downside potential? Which there's a chance it does. We've only got the first lump. See, and look, here's our same little pattern down here for our divergence. Lower, higher. And if you come over here, same thing here. Now this is in the yield max version, but you can see you got lower, this is lower, 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 higher. That's your divergence. So are we going to get some divergence in here? Are we going to get another little pattern down in here? All right, so what are we going to do? Palantir. Well, if your average price is below, even at this point, it's not going to hurt you to put some in right here. But it looks like to me, we might get in the month of December, break those blue lights, and we might get another down flush. Doesn't mean it's going to happen. I thought that back here too. I thought we were going to get an ABC back here, and it was going to down flush, and it didn't. It took off. So you had your 3-drive pattern, drive 1, drive 2, drive 3. I thought we were going to get an ABC pattern here, and it failed. Several of them did, right? We got that extra push higher at the last of the year, and I started putting some more money in, thinking, well, we're not going to get an ABC. We're going to start getting a 3-drive pattern back up, which we may still do. See, this just be maybe a new Darvis box starting out in here. Maybe our Darvis box ended prematurely. So that's our Darvis box, right? And we didn't get the down to bring the Darvis box over here. So maybe this is coming up. The problem is we broke it right here. So that's the breaking of the rules. See that one bar right there came down, made a new low. It broke. Well, no, it didn't, because this one here, we got that there, and it didn't break that. So we're still making higher highs or higher lows. This is the lowest point here. This was a higher low. So technically speaking, we're still in an uptrend. That thing could take off and go some more. That could be your ABC, and this could be the new Darvis box. Start our new Darvis box right here. And go up into the 3-drive pattern. Drive 1. You almost want to call this drive 1, drive 2, counter trend. We might, I don't know. I think we're going to get another drop down in December. I think we're going to get this market's going to see it down in here. Palantir, snowflake. Same thing. All right, so we've got this nice big 3-drive pattern here. Drive 1, drive 2, ugly 3 down. We only got 1 down. Actually, we could call this an ABC up here, but that's only 2 drive. But you got the kind of a little, but nonetheless, we got drive 1, drive 2. We're getting a counter trend. Could we get a drive 3 higher? Either way, that's pretty scary to be into this market up here. And we're getting a little bit of a pullback down in here. Let's go see what that would be snowy. My average cost on Snowy is at 15, and it's currently down here. So yes, I could start putting money into Snowy because it's below my average price. I'd bring my average cost down, even though Snowy up here looks like we got a little ABC would bring to here, right? So if we got a little ABC pattern in there, it'd bring it back into the Fibonacci sweet spot once again. I mean, it came down there already once right there, but I think it'd come down again, down to 61.8. Depends. I think we're going to get more selling in December than we're going to get buying. I think people are going to be doing some dollar cost averaging, and I think they're going to be doing some tax loss harvesting. And so if that's the case, if they get out of snow to tax loss harvest because of all the money they've made, they can't get back in for 30 days, right? So they can't get back in until January. 30 days from anywhere they sell it during the middle of December. If they wait clear till the end of December, they can't get back into Snowy till the end of January, 1st of February. They just wanted to manage the position at a higher. Scott's asking why did it reverse split? Because it got uncomfortably low for them. They give back too much of their ROC. I think I would like to see. they have what the name of the company is Yield Max, right? And I was listening to a that's a good question, Steve. I don't know. I don't know why they did it, but I'm going to tell you some BS lines. All right. They said that and I didn't even know Tesla was on the list. I thought they were just um, doing their ones that were diversified funds. I didn't know they did any individual single stocks. But they said I was in a forum the other day and I was listening to them talk, and they said, well, you got to realize the name of our company is Yield Max, maximum yield. We're trying to return to you the maximum amount of yield that we possibly can. And so that eats into the NAV sometimes, and it makes the NAV go down. It's not that you're losing money. It's that they're giving you your NAV back. And is that a problem? No, not really. Why would you care? Give you your money back faster. You get a lower cost basis on your shares. There's an article in Pitt News Magazine that describes it really well in the December issue. Again, after this class, I'm going to go and we're going to release the December issue of Pitt News Magazine. And that actual question, Steve, is in an article in Pitt News Magazine. Doc Brown writes it, and then Claire comes and writes even a simpler version so that you can kind of like, Claire's like, I have no idea what Doc Brown just said. Here's the way I understand it. And then she wrote an article that simplifies it even further so you can understand it. But in the forum, they were talking about Yield Max. Or like, the name of our company is Yield Max. And if we give you back because they give back the maximum yield, sometimes they do ROC, which is giving you back some of your own money, right? Cash and capital. So if they give you back some of your own capital, it lowers your cost basis. So if you got in at 10 and they lower the cost base by sending you back some ROC, then your cost base is no longer at 10. It's now at 9 because they give you some of your money back. And then that increases your annualized return. It's games they play. I think it's a little gamesmanship that they're doing to bring those numbers back into line. But you don't pay taxes on that ROC either. So you have to take that into consideration. That's why you have to go work with your tax accountant to pull up your accounts and look at what's ROC and see if he can make a little bit better wild ass guess than you can on how much taxes you're going to pay. But I wish, and this is just my wish, and I tried to ask them this question in the forum, but they wouldn't let me speak. So maybe next time they have a forum, they'll let me speak. But I want to ask them why they're doing. You've heard them talk about these target 12s and target 25s, right? So a target 12 fund is SOXY. And I told you I had money in SOXY and I didn't get it into my spreadsheet yet. Let's go look at SOXY and I'll kind of go down this little rabbit hole with you for a second, Steve. If we go into PQRS, where's SOXY? Oh, it's not in here either. I have a little SOXY. I have about $65,000 in SOXY. And I probably got a really bad average price. Let me go look and see what my average price on SOXY is. I got 1,000 shares of SOXY at $60 a share, but I didn't pay $60 a share. I paid $59 is my average cost. So I'm actually making money because it's at 50. Oh no, I'm right there. I put 60. See, stupid land. Why do you do things like that? Why do you buy? Because SOXY was a 59. See, I get mad at myself too. Do stupid things. In hindsight, I look back and I go, why were you doing that? But at the time, it was a buy signal, right? 59.35. So 59.35. That's right where I got in. So I got in right there, right on the break. And so I didn't get out because it came down here. I'm not going to get out. I'm going to try and work to get my dollar cost average down lower when I buy back in when it comes down here. But the reason SOXY is you can see in the name, it's a target 12 right up here. See where it says target 12? That means they're going to try and return to you a 12% annualized dividend return. So we're going to come in here and go SOXY in portfolio matrix. And so see, the gain is negative 43. Oh, that's NVIDIA. I got to do SOXY, SOXY. Come on, SOXY, come on up. Here we go. All right, the gain is 18. The yield is 11.12. So they're pretty close to hitting a 12% annualized yield. But SOXY is able to produce a 30% return having the gain. But I don't want a gain. I don't want a gain. Why are you giving me a gain? I get a gain of 18%. Everybody's like, Land, gain is great. Don't you want a gain? No, I don't want a gain. I want the gain to be 0. I wish they would do a target 3. And they say, and so what they would be doing is they would trying to make the NAV, the net asset value of the fund, be a gain of 3 or a gain of I would like 0. All right, a gain of 0. But everybody wants a little growth. Okay, great. Have some growth because we've got the word has slipped my brain, my worthless brain. So we have inflation. Let's say inflation is 2 to 3%. All right. So if you just tag your gain to inflation, that would be really cool to me. I would like to see a target, an inflation target inflation. That would be the name of the fund. So they're going to target inflation. So growth is going to be at 3% or 2%, whatever inflation is. And so they're going to try and maintain inflation so that it doesn't lose value, but it's inflation covered, right? And then the rest of it would be yield. So whatever they could pull out in the yield, who cares? I mean, it's if it's 11%, 20%, 30%, 60, 100% yield this month, great. If it's 30% yield this month, great. That's great too. But maintain that target 3, right? I want it to be called target 3, but not yield, target 3 on the growth. And then whatever the yield is, let the yield come in at whatever it is and just let that growth be stuck at 3. But that's not how they do it. So what they do is they say, okay, we're going to do yield at 12%, target 12. So you can get a 12% yield. Well, that means the gain can be anything. Gain can go way up, gain can go way down. Who knows what gain's going to be? Because they're only taking yield out of 11%. So anything that's not yield at 12% is going to be gain. Well, that gives you a huge amount of gain. Well, you don't want gain. It's unrealized gains, but you have to sell your shares to realize it and get it out of there. And if you never sell your shares, you're just going to build up this great big portfolio of gain and live off this little piece of yield. I want it the other way around. I want little tiny gain and huge yield. I want to live off the yield. But now I can't get to it. It's locked up money. It's not doing me any good to be in there. It's worthless money. It's why did I put $65,000 in this stupid target 12? Now I got 18% gain that's stuck and I can't get to it because if I sell my shares, I no longer get the yield, the rotten little tiny 12% yield. Now I'm stuck with a whole bunch of gain. What good's that? I don't want to gain. That's my brain. That's how I think about yield first investing. I don't want no damn yield. I don't want no damn gain. I don't want my gain to go to 0. I don't want my gain to go down. But if it does, that just means they gave it to me in my yield. And if they gave me more than what my yield was, then it comes back as ROC, and they just lowered my cost basis, which is fine with me. I don't care. It gives me my money back faster. And all I'm really looking for is break even point, right? If I gave you 10,000, how long is it going to take you to give me my $10,000 back? That's what I want, so that I'm on a cash cow and I have no more out-of-pocket risk. Of course, I put it back into other things, so I still have out-of-pocket risk. But if you just keep it in cash, you put in 10,000 and in a year you get 10,000 back. Well, you still got your $10,000 worth of shares or whatever it valued to, right? But you got your $10,000 back. Now you have no out-of-pocket risk. You don't really care what happens to that 10,000. Just keep sending me money. I don't care. I got my 10,000 out. I have 0 out-of-pocket risk. Just keep sending me money. You take that money. If you put it back in the market, well, that was your choice. You put it back in the market. Now you got risk on that money too, which is fine. That's what I do. But you could take that money out. You put 10,000 in. They give you all this yield. You could take it and go buy some equipment at your business with it, right? I got a buddy that does that. When I showed him this strategy, we went to the pheasant farm. How many of you came to the pheasant farm with us? We went to the pheasant farm and I showed him this strategy, and he owns a business. And he's like, man, I got a bunch of cash sitting in my, operating capital. I could put the operating capital in here, and then it's going to pay me all of this money for operating capital that he's got more operating capital than he needs to operate on. So he's got a large chunk of operating capital. He said, I could put it in here, and then it's going to send me this money all the time, and I've still got the money. I could buy equipment with that money and grow my business. So it's another source of income for him. So that's what he's doing. He's buying equipment for his company off of his yield max funds. And he's not reinvesting it into the stock market. He does. He puts some back in because he's got more operating capital than he needs. So as the operating capital comes in, he'll put it back in there. But that money he takes and uses it as an income source that he buys equipment with, rather than going in and buying more stock. He uses it to buy equipment. So, you can do whatever you want with that money. You're going to have to pay taxes on it. And that's what I'm struggling with right now. I got $400,000 I'm going to have to pay taxes on. That's going to suck. Like, I don't even want to think about how much money that's going to be. So I'm not going to actually take my shares out. I'm going to have to get a margin loan. And then I'm going to have to make next year's going to have to pay off that taxes before I can start showing profit. So I got to pay off this year's taxes with next year's income. See how that works? All right, so that's Soxy. So I got some Soxy, but I'm just really questioning why I have Soxy, because now it's going to have a bunch of growth that I can't touch, can't get to it. And it's not doing me any good. It's not earning me any interest. It's not earning me any yield. It's just growth on a worthless stock that I can't get to, because if I sell it, then I'm not getting my yield anymore, my 12%. But I could probably sell the whole damn thing, get rid of Soxy, and go put it into something good like Tesla that's really giving me a nice return, or in Palantir, right? Anyway, that's my little, and I might change my mind. Oh, look, Tesla hasn't done the split yet here. Tesla, they haven't split this. The Track and Trade hasn't split it yet. I wonder what's the other one that split. It was I don't have that one. We could pull it up though. Ulti split today too. Yeah, there it is. There's your split in Ulti. Reverse split. So what does it do? What does it affect? Nothing. It's window dressing. Start the next year with a new window dressing split. Now you have to pay $39 for the shares rather than $7 for the shares, but it doesn't matter. The dividends are going to go up an equal amount too. So it's just window dressing. So Steve's asking, why did they do the split? It's window dressing. It looks better. So that's why they did it. All right. It's just mathematics. It's just changing the cosine of a sine and the cosine of your, or the sine of your, it's just changing both sides of the equal sign. So it doesn't mean anything. It's just window dressing. Are you making money? That's the question. Are you making money? And let's go look and see. My Tesla. Did I make any money on Tesla this year? TSLY. I put 50,000 in. Current value is worth 80,000. I made 30,000. If that's correct, I'm going to have to double check it now, but I think that's correct. Dividends, grand total. I've got 61,000 in dividends off of my 50,000. So I put in 50,000. Current NAV is 80,000. So I've made 30,000. Yeah, so it's a 60% return. And then I made $61,000 in dividends. And then so dividends plus NAV is $91,000 in profit. I put in 50,000, so I got 184% return. That's all correct. I reinvested 30,000. So total capital invested is now 80,000. So I have a new cost basis of 80,000. But when I go and start my January, whatever's in there is going to be my new cost basis. So I'll have a new cost basis. It'll start in January. But then you see over here, I got 351 shares of that reinvested money. Current value, 13,000. So I lost 16,000 in Tesla since I put it in there for a loss of 55,000. But I made, annual dividend. I think I got something wrong here, because it's saying I only made $1,600 in dividends against my $16,000 loss. And I don't think that's right either. I got some errors in my spreadsheet. I'm not going to send you the spreadsheet. I just was trying to hurry and get this done so I could send it to you in the December issue of Pitt News Magazine, because I'm working on this new spreadsheet, so it's not quite so complicated. This one was really complicated. So I tried to simplify it, and I've got still got some errors in it, I think. So I'll figure it out. I'll get it to you. Probably come out in the January issue then, since I've seen all these errors. All right, guys. So that's all I got for you today. Does anybody have any questions before I let you go? It's been a long class today, but I think we covered a lot of ground. Let's see what I got going here. Go back over to here and here. Let's go look at some fun stuff. Let's go play for a minute.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, tonight we're going to have class at the university. Okay, so we'll see you down at the university tonight. And for those of you who are enrolled, it's the options class. We're going to show you how YieldMax makes all their money, how they're able to give these big dividends with yield, how these big yields are made, because that's important, right? We want to know how these big yields are made. All right, guys, that's all I got for you. We will catch you tonight at the university, or tomorrow. Tomorrow we'll probably have our first lab for the university, so we'll be starting options tomorrow. We'll do that tomorrow morning at 8 o'clock a.m., bright and early. See you tomorrow morning, 8 a.m., for an options class. All right?
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.